The stock for Cidara Therapeutics, Inc., traded under the ticker CDTX, is currently sitting at $221.50 per share, an astonishing surge that has seen the stock price more than double today, moving up over 100% in intraday trading. That explosive move, which has momentarily paused just below the recent high of $221.75, is precisely the kind of price action that stops the market in its tracks, immediately exceeding any baseline expectation for a clinical stage biotech company, where daily movements are usually measured in single digits or low double-digit percentages, not a clean sweep doubling of valuation. The underlying cause isn't some slow-burn clinical trial readout or incremental data release, which is the common market narrative for biotech spikes. The reality, the unexpected insight that investors did not necessarily see coming in the immediate future, is that Cidara has become a major acquisition target, with a definitive agreement now in place. This isn't just an institutional investor increasing their position or a rumor floating around a forum. This is the full exit strategy hitting the tape, with a major pharmaceutical player stepping in to buy the company outright. That single piece of information, the hard reality of a cash-based acquisition offer, is what drives a biotech stock to a level that essentially caps its price, aligning it almost perfectly with the acquisition price, and it fundamentally changes the entire investment thesis for anyone currently holding or looking at the stock. The general belief about Cidara Therapeutics up until this morning was built around two key pipeline assets and the associated regulatory hurdles: rezafungin, its novel antifungal, and CD388, the long-acting antiviral for influenza, which utilizes the company's proprietary Cloudbreak platform. Investors were essentially betting on the successful commercialization of rezafungin and the clinical progression of CD388 through Phase 3 trials, hoping for a successful outcome that would justify a higher valuation somewhere down the road. It was a high-risk, high-reward proposition typical of the biotechnology sector, where the path to profitability is long, expensive, and riddled with potential setbacks. This is why you see companies like this often engaging in secondary offerings to raise cash, a necessary evil that dilutes existing shareholders but funds the research and development necessary to get their products to market. For those who follow biotech closely, you might compare the risk profile to holding shares in a number of smaller firms hoping for a big payoff, much like someone might approach a select group of high-growth tech firms rather than sticking exclusively to established names like Apple stock or Nvidia stock, or even the diversified portfolios offered by platforms like Schwab Intelligent Portfolios. The contrarian take now, the deeper take that challenges the old market narrative, is that the waiting game is suddenly over. The perceived risk has evaporated and been replaced by a concrete payout, essentially turning a long-term clinical catalyst bet into a near-term capital distribution event. The stock is no longer trading on the success of the Phase 3 anchor trial for CD388, but on the certainty of the acquisition price. Looking at the recent stock movement, the sheer volume tells the whole story. Before the acquisition news, CDTX had an average daily volume well under 1 million shares. Today, the volume has absolutely exploded, signifying massive, frantic trading as arbitrageurs, institutional funds, and retail investors all move to either liquidate their positions near the offer price or establish new positions to capture the small remaining arbitrage spread. This dramatic single-day movement is a complete divergence from the stock's recent trend, which, while highly volatile and upward over the past year, having surged from its 52-week low near $13, had seen some choppy action in the last few weeks around the $100 to $110 level. We saw a spike a few days ago after some analysts maintained bullish ratings and increased price targets, with one firm raising their target to $135. However, even that positive movement, driven by the announcement of a breakthrough therapy designation from the FDA for CD388 and the acceleration of the Phase 3 trial, was incremental compared to today's massive jump. This demonstrates the immense premium a large pharma company is willing to pay for a late-stage potential first-in-class asset. The institutional activity over the past few quarters was already signaling increased confidence, with major players like RA Capital Management, Bain Capital Life Sciences, and Point72 Asset Management significantly increasing their holdings. Their heavy positioning in the stock, detailed in their 13F filings, now looks prescient, reinforcing the idea that smart money was already betting on a positive exit scenario, whether through successful commercialization or a buyout. This kind of high-stakes play is a far cry from the straightforward approach of using platforms like Fidelity, Fidelity Investments, or other established investing sites for diversified mutual funds or Fidelity ETFs. This is pure high-risk, high-reward biotech speculation that just paid off handsomely. Now let's briefly touch on what the company does, since the focus has shifted so completely. Cidara Therapeutics focuses on developing targeted immunotherapies, primarily through its Cloudbreak platform, which creates drug Fc conjugates, or FDCs. The idea is to combine a potent small molecule drug with a human antibody fragment to extend the drug's half-life and potentially enhance its therapeutic effect. The main assets that drove today's acquisition are twofold. First, Resifungin, an antifungal drug for invasive candidiasis and candidemia, which has already received regulatory approval in the US and EU. This product provides a potential near-term revenue stream for their partner, but the core value that the acquiring company is truly after lies in the second asset, CD388. CD388 is an investigational, long-acting antiviral designed for the universal prevention of seasonal and pandemic influenza in high-risk individuals. The market narrative had CD388 positioned as a critical Phase 3 candidate with fast-track and breakthrough therapy designations, aiming for a single seasonal preventative dose, a potentially enormous market opportunity if successful, essentially offering an alternative or complement to the annual flu vaccine. The buyer has stated explicitly that the acquisition is a move to diversify and expand their respiratory portfolio with a late-phase antiviral. The company's underlying financials have historically been typical of a pre-commercial biotech: negative net income, consistent net losses as they heavily invest in research and development, and a reliance on financing events, though their cash position had been strengthened by recent capital raises and milestone payments, such as the $45 million milestone payment related to CD388's progress. This cash cushion was important, but ultimately the value was in the pipeline and the platform itself. The future outlook for CDTX shareholders is now remarkably simple and definitive. The expectation versus reality tension has completely collapsed. The previous expectation was years of clinical trial results, regulatory submissions, potential rejections, more financing, and then maybe a profitable product. The reality is a definitive timeline for a cash payment of $221.50 per share, pending shareholder approval and customary closing conditions. The core catalyst is no longer the Phase 3 Anchor Trials interim analysis in early 2026, but the close of the tender offer. The only remaining risk is the minimal chance of the deal falling apart due to regulatory or financing issues, which is typically low in a definitive, fully approved agreement of this nature. This outcome provides a massive return for those who took on the high clinical risk earlier in the stock's life. It also raises fascinating questions for the broader biotech landscape. In a world where self-investing is becoming more popular through platforms like Robinhood, Robinhood Stock Trading, and SoFi Invest, seeing a major pharmaceutical company pay such a high premium for a late-stage asset reinforces the value proposition of specialized, targeted drug development. It makes you wonder how the valuations of other platform-based biotechs with strong Phase 2 and Phase 3 data might adjust in response. This acquisition suggests that late-stage candidates with breakthrough designation, especially in large, underserved markets like influenza prevention, are an absolute premium target for consolidation. For retail investors utilizing tools like SoFi Invest or interactive brokers, this is a clear example of how a singular, unpredictable event can drive a massive terminal return, completely eclipsing the more common incremental gains seen in general market investment. This major development immediately simplifies the conversation around the stock, but it certainly doesn't make it less interesting for those who follow market structure and high finance. The move is a testament to the value of specialized scientific innovation. Cidara Therapeutics built a platform, developed a potential blockbuster product, and the market, through a large-scale acquisition, immediately recognized that value. The final analysis, then, is that the company's internal growth expectations were superseded by an external validation that provided maximum certainty and a colossal premium. This is a crucial distinction. The market didn't just re-rate the stock, it took it off the board entirely at a guaranteed price, a far stronger outcome than any analyst upgrade could provide. It's a clean and decisive victory for the company, its management, and its patient shareholders. Comment below with your thoughts on how this acquisition and the resulting huge premium will affect the valuations of other small to mid-cap biotechs with late-stage assets in their pipelines.